What are the downfalls, or what do you need to know about renovation loans before you go get one to buy a home? So I'm talking specifically about 203Ks, which is FHA's version of a rehab or remodel loan, where you can buy a house and roll in money to do the upgrades. I'm talking about HomeStyle. Again, Fannie Mae's version, same thing. Buy a home, roll in money for the upgrades or repairs or remodel, whatever you want to call it. And then the Freddie Mac version, which is the choice program. So again, all these programs are all remodeling things. What you need to know, and this is the same conversation we have with everybody who calls and says they want to explore or talk about this. There are things you need to be aware of that are absolute downfalls to this program, to all these programs. So first, the hardest thing, the reason why these typically don't work out, when we get phone calls, the reason why these ultimately end up being things that people don't close on, because it's a lot of phone calls, a lot of conversations, not a ton of closings compared to normal loans, right? Like we talk to this many people, we know we're going to close this many. These are a smaller conversion. Why? Because it's hard to make the numbers work sometimes. Here's what I mean. If you're buying a home and let's just use a $400,000 purchase price, right? So I don't care, use 300. Let's use a $300,000 purchase price. And somebody wants to come in and put in $50,000 worth of improvements. They just want to, upgrade the kitchen that's, 20, 30 years old. They want to put in some new flooring, new countertops, new cabinets. Say it's going to cost 50 grand. We can even say maybe it's going to cost 100 because they're going to throw in, remodel the bathroom, the master bath, because those are the two best places to spend your money, the kitchen and the master. So they remodel those things. It's going to be 100 grand remodel. And they now say, man, Mortgage Mark, we want to do a 203K or a HomeStyle or whatever type renovation program. We want to buy this house and get it done. The very first thing we start talking about, there are other things we will cover, is the appraisal. So if somebody's about to go spend 100 grand in today's market, I'm willing to bet 45% of that, maybe more, is at least margin and revenue and profit for the remodelers. So meaning they have to pay their workers, themselves, and all the stuff it takes to run a business. So it's revenue. So if somebody spends 100 grand in my example, I'm willing to bet 40 to 45 grand of that is just going to just people, companies, not to the house. That means the other 55 grand, the countertops, the cabinets, the flooring, that stuff stays in the house. So of the 100 grand you're going to spend, and maybe I'm off, maybe it's 30%. You got somebody's giving you a deal. I can't imagine it's much lower than that, but maybe it is. But the point is, you can see how the math suddenly gets really tough because when that much money goes out, that doesn't stay in the home. And when it goes in the home, it then is done. So let's say you got 55 grand worth of materials going in this $300,000 home, but we are going to use the 300 purchase price. And if you want to get maximum amount of financing for this thing, you're hoping it appraises for the 400. And if not, then maybe you have to bring more money down. So if somebody says, hey, I'm going to put down 100 grand for this loan, then we're probably good. Because again, if they're buying a $300,000 home, they want 100 grand, they're going to put 100 grand down in. That means they got a $300,000 loan. And if they put enough value to add 50 grand in value, great. 203K allows it, HomeStyle allows it, Choice allows it, wonderful. But if somebody says, man, I'm trying to get in with only 5% out of pocket, so now this is going to be essentially a $400,000 cost, 300 to buy it, 100 for the upgrades. They're trying to get with only 5% out of pocket, that 20 grand. Well, if the appraisal comes back at 370, 380, I don't care, whatever you want, number you want to pick, lower, then all of a sudden, let's say it's 380. Not only do they got to come up with the 5%, which I can't do 5% that quickly off the top of my head. So it'd be 16 grand. So I guess I can. No, that's not all right. Should have done 17, 18. Yes, shoot, whatever it is, 17, 17.5, $17,000, $18,000, whatever it is for the 5% down off that 380 number. And no, it's 19 grand. Boy, it's embarrassing, but I'm going to keep going with it. We're going live. This is real talk, guys. So the 19 grand, down payment. That's 5% of the 380 number, because that's what the appraisal came in at. They need 5% in the HomeStyle. You can do less. FHA 203Ks can do 3.5. Let's say it's 5% down. They need that 19 grand. Well, if it's a 380 price or value, sorry, and it's 400 cost, they also got to come up with that difference between 400 and 380. So they got to come up with the 20 grand just to get that spread, and then 5% on that 380 number. Well, they said, man, I just don't got it, Mark. I ain't got it. I don't have 38 grand. I had the 5% that I was planning on, which is 20 grand. Okay, cool. Well, now what they got to do is go back to the remodeler. And by the way, this isn't discovered. That value is not discovered until we've ordered the appraisal. And we can't order the appraisal until the plan, specs, and budget are all finalized. And chances are a home buyer can't get the plan, specs, and budget finalized until they actually got it under contract and have paid for an option period and done all this work. And that could be weeks. So we're just sitting on our hands as a lender, waiting for plan, specs, and budget to get done, then give it to the appraiser, wait for the appraiser to do whatever they do. And they're going to go around and look for other what can be homes in the area that can be with all these upgrades. They're going to try to compare it to homes with these upgrades and give us that value. And when they say, hey, it's worth 380, not 400, we got to go back to the drawing board. And now the buyer has to say, okay, shoot, I got to cut down on my what I want. So maybe we don't do that bathroom remodel. Okay, let's say that's 30 grand. Okay, instead of spending 100, we're going to spend 70 now. Okay, well, guess what? This is kind of like unfortunately, it's a perpetual thing, because now we got to go back to the appraiser. Hey, Mr. or Mrs. Appraiser, please do it now with only these $70,000 worth of improvements, not the 100 that we originally gave you. Okay, well, all of a sudden that 380 value may go down to 350 because now that bathroom's not included. And all of a sudden you just keep chasing this to the bottom and the appraisal doesn't work out. That is without question the most annoying, the most expensive waste of time that we all have together. And so what I would caution you on, if you're listening to this and you're a buyer or a realtor or somebody that's thinking about doing this, make sure you know that you are adding real value add items. Landscaping doesn't count. I mean, yes, you can do it if the appraisal works, but it doesn't add value to the home, right? Add real value add projects. Then know your market really, really well and hire and work with a true professional of a realtor that is really good at knowing the market and knowing what comps are available, so that an appraiser can get you a value that is accurate and supports all your improvements. This is without question, it's a long conversation. I mean, it's, what are we on the video? 15 minutes right now? I don't know. Yeah, 15 minutes, give or take. And this video is just, it's part of the conversation. So now somebody says, oh man, I got it. I know it. I'm going to buy it for 300, put in 100. Comps in the area are 500 grand. Awesome. Hopefully that's true. And let's say it is. The appraiser goes out and says, cool, they do this work. It's going to be worth 450, 500. Congratulations. We've overcome probably the biggest hurdle. The second thing you need to know are some of the obstacles or downfalls for these things. For all these renovation programs, they do have extra cost, closing cost. The reason being, there are departments at mortgage companies, ours included, there are people that do just this. They need to get paid in addition to all the other normal people that do loans. So now you got this other department, and you also got inspectors, third parties, things that happen where the inspector needs to go out at different processes to issue or to ensure that work is getting done properly, money's being spent where they said it would, and everybody's still playing nice, and contractors and homeowners are cooperating, and the money's being spent where it should. So there's third parties. This is a generic number, so don't hold me to it. But for FHA, 2 or 3K, for Fannie Mae's HomeStyle, for Freddie Mac's Choice, they're all going to have different numbers. But I would say, generically speaking, you could be looking at 2,500 to 3 grand more in fees just for that renovation piece. So you're like, okay, that's not bad. And I agree, not bad. That's fine. I mean, at the end of the day, you're spending 100 grand. You're going to pay more for it for third parties. It is what it is. You're also going to pay a higher interest rate. It could be half point to a full point higher than normal rates. So whatever your FHA rate is, whatever your conventional rate is, you can expect, I would say minimum is a half a point higher interest rate, could be as much as a point, maybe even a little more. Just depends on the market, the program, and all the parameters that go with it coming into what makes interest rates. So now you're paying a higher interest rate on a loan. You're paying more closing costs, and you got to make sure that appraisal works. So the good news, and it's not, I'm using air quotes for the good news. The good news is once you do this, what we see a lot of times, depends on the market, somebody gets a rate of X and they then go, and let's say the market after they buy goes up and down, up and down, and up and down, but ultimately moves sideways from an interest rate standpoint. And let's say they do this work. 6 months later, they're done. The work is done and completed. The house is now worth, in our example, let's say they spent $100,000 on the $300,000 home. It's worth the 450, 500. I don't care. Whatever number you want to use. It's now worth money. They're done. The work is done. Kumbaya. Everybody's happy. If the market stayed flat from an interest rate standpoint, oftentimes we'll see folks refinance because now they can do a quote normal mortgage, not a rehab loan, and lower the rate. If interest rates have gone down over that 6 months period, more than likely it's almost guaranteed they're going to refi, because not only can they get a normal loan where that picks up that spread in rate, they can then capitalize on the lower market rate as well. So they can just do a refinance and significantly lower their rate. Good for them. If rates went up, they may not do anything. Again, in all these scenarios, Mortgage Mark team will absolutely help make sure refinance makes financial sense. We're not just going to spend your money to spend money, do a loan. We'll make sure there's an actual financial benefit for you doing this. But if rates go up, good news is you're fine. Yeah, you got an artificially higher rate when you bought it, but if rates went up, you may be sitting in the best rate available in the market at that time. So that's something to consider as well. But those are absolutely the three biggest downfalls: the appraisal, the rate, and the cost. I don't think the rate and the cost are that big a deal. That's just the price to pay. It is what it is. It gets you in the home, makes it your home, right? It's all your fingerprints and all that stuff as far as the colors and whatever you're doing. That's fine. The biggest hurdle, it's not even a downfall, it's just a hurdle, is that pesky appraisal. So please, 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 please watch this video again if you didn't make total sense the first time around. But just know the money you spend, it's got to be justified in the appraisal based on your down payment. If you're like, man, I got enough money to put down, I don't care. Well, then maybe you don't need a renovation loan after all. Maybe just buy the home and then pay cash and do a small down payment, right? Let's say you do it, because we've seen this too. If this, my example, somebody says, well, I got $100,000 to put down. Maybe they just put down 5% on their $300,000 loan, pay cash for the remodel when they're done, and then refinance and get, or not even refinance. They could call in and get their mortgage insurance removed because they picked up so much equity. And they did a normal loan, so they don't have to pay the extra fees, and they don't have to pay the higher rate. They can do it. So that's our job, to help you determine which one's best for you, or whatever you're thinking. But please, 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 just understand, before we get together and have a 20-minute conversation that's going to say every single thing I just said here, watch this, make sure you fully understand it, and get with your agent, your realtor, get with your contractor, and try to do as much homework up front before you come to us, and then spend your time getting a contract or a house under contract, paying your option money, paying your earnest money, paying for the appraisal. Try to do all that ahead of time. We are certainly here to help you walk through the process, but I highly, highly, highly stress and recommend do this, because these are the downfalls and the pitfalls and the hurdles you need to overcome to do any type of rehab loan, remodel loan, FHA or otherwise. FHA 203K, Fannie Mae HomeStyle, or Freddie Mac Choice program. So let us know if you have any questions. The Mortgage Mark team is here to help. As always, when you think mortgage, think Mark.